Well, welcome back to Mortgage Express. This is March and we like green, so we're going to talk about some money and how to invest.
Maybe become a realtor, or not realtor, but like a real estate investor.
Own a lot of real estate, that kind of thing. So this will give you some ideas. We're going to touch on a couple of other things that could help you if you're self-employed. So that goes in, but this one's kind of geared towards investors today. So that's what we're going to talk about. Hopefully you'll learn a little bit and we'll give you some information. So
I'm Mallory Fraser, if you didn't forget.
Oh, I'm Dawn Hall, sorry. Dawn Hall, Mallory Fraser, your Mortgage Express team. It's been quite a week already, and it's only Tuesday. So I had a Monday yesterday, and I'm having another Monday.
2 Mondays in a row. That's always, I mean, that's it's the story of our jobs, right? Sometimes.
It's the Mondayest Tuesday I've had in a long time.
Yes.
So let's talk about investments.
Yeah.
Tell us what we're going to talk about today, Mal.
We're going to go over pretty much the two basic, I guess, like the most popular ones that people like to start with the real estate investments, which is the DSCR loan. And then we'll kind of go over that. And then the bank statement loan. And then kind of like what you're looking into as an investment property. And we're also going to understand, what loan type is best for you. We'll go over that, of course. And then kind of building up your real estate portfolio and kind of getting going and talking to you how to get that started and getting you in the right places. But we're also going to learn to understand how you can use the equity into your own home to even get you started. If you don't have anything started yet.
Because a lot of people don't even know, I'd say they can't invest in property because they don't have the money, and they don't realize they can use the equity in their home.
Correct. At least to jumpstart it.
To build more equity. Right. So we're going to start with DSCR loans. So
what does DSCR stand for?
Debt service
coverage ratio.
I always forget the C. Debt service coverage ratio.
Yes.
We like to use DSCR loans a lot, and especially if you're an investor. A lot of people always think of just a conventional loan, go get an investment loan, but you're going to get the best rate, yada, yada, yada. But here's the thing. DSCR loans are almost the same rate as a regular conventional loan.
Absolutely.
And the cool thing with DSCR loans are we don't need anything from you. What we're looking at is the debt service means the rent you're going to receive on that property is what we're going to use to qualify you and that property on. So we don't use personal income. We don't even want to know whether you have a job. We don't care. We're not looking at anything like that. We do pull your credit report, of course.
Absolutely.
Credit does have an impact on your actual rate when we get down to that, and also what the loan to value is. But we can do different loan to values. I believe, I think we can go up to 10% down, can't we? On a
certain
DSCR?
certain of our brokered, but again, that comes with, could get a higher interest rate because you're putting lower
less
down.
money down.
A lot of investors are kind of like, it's 25% down, or 20%. Usually they tend to go that way anyway.
And that's kind of where we sit. That's going to give you the sweet spot with the rate and all of that. It's also, you have to keep in mind, the higher the loan amount, it might not cover, the rental might not cover. And the cool thing with some of the DSCR loans that we do, because there are a lot of lenders out there that do DSCR loans, but a lot of them will not use like Airbnb or Verbos or that kind of thing.
You have to be an experienced renter.
A lot of times you have to own your own property. I have a investor right now who actually lives at home with his parents. He's like 25 years old, just chooses to not go out. He doesn't need to, but he has several rental properties, and we can use those rental properties in order to show that he has, has done it. But when we first started, no one wanted to do it that way because he didn't own a primary property.
Absolutely.
So that's one of the guidelines that we run into that other lenders have, that we have a program that you don't have to own your own, your primary residence.
No experience?
And no experience. So again, it's going to go based on either the annual rental income, or it's going to go based on your Airbnb verbos. And sometimes we did a duplex where he had annual rental on one side
and short term on the
other side.
And I love it because he told me, he goes, I always want one to be long term so I can cover the whole mortgage, mortgage payment, and then I make the other one, and I'm just like, genius. Genius.
So that with DSCR loans, it doesn't matter how many properties you have, and that's what you run up against in a conventional loan.
Yes.
You can only have 7 mortgaged properties,
right.
So then you're stuck.
Yep.
You can have more properties, obviously, but only 7 mortgaged. Well, if you're an investor, very rarely do you own all the properties straight out, because you're not really doing what you need to do with your money.
Yes.
So again, we have great programs. We have in-house DSCR loans. So that means we can talk to our own underwriters, work through it. So that's a plus, because I don't think I know of any lender that has their own in-house DSCR loans. We also continue to have our broker partners. So we have a plethora of different places to place you based on, again, your specific needs.
So how do they know if they qualify for the mortgage?
Well, basically, you're going to look at what the mortgage payment is, PITI, taxes, insurances, everything. And then the rental that you're going to get needs to at least cover that 1-to-1. Sometimes, again, some other DSCRs require it to be 1-to-2 or 1 to, a little higher. Sometimes, if it's a problem where you're not getting quite enough income or from it, and maybe it's just below 1-to-1, we have gotten those through as well, because again, with our in-house, sometimes we can do that. Also, one of our broker partners will sometimes take less than the 1-to-1, but the general rule of thumb is 1-to-1. So the rent must cover your PITI.
Got it. Because I know a lot of people see that 1-to-1 and they're like, what does that mean? What does that mean?
Yes, and again, we talk about it in our mortgage lingo.
Yes.
We use it every day, and sometimes we forget that you don't use it every day. So thanks for
You're
bringing
welcome.
that.
So the next one we're going to talk about is a bank statement loan, which I find is a very good one, especially if you're not showing the income on your tax returns and you're self-employed. Always a perfect example is if you own real estate and all your rent is coming into one bank account. Now, we do have lenders who will do mix of personal and business. I personally say, hey, if you're getting all the rent, put it into one bank account.
Correct.
Don't mix it with your others, and then it shows you everything that's coming in. Right. We can show that it is all just your rent and everything that.
Putting it in it's separate. A lot of investors, when they have certain houses, will have bank account for,
X property.
Northwest 22nd, bank account for, or an LLC called Almond, called Pineapple, whatever the street name is. And then that way you keep everything separate. And it's also a good idea too, because if something were to happen, they can only sue the one property, not all of them.
Correct.
So, that again, that's not our forte.
No.
We want you to talk to your attorney on that.
Yeah.
But, like Mallory was saying, definitely keep it in the bank, in your one bank account. Don't mix, and don't transfer funds from either side. I'm running into one of those right now. So don't transfer from here to there. Don't Zelle yourself money. Don't don't do all that.
So we usually use 12 to 24 months of bank statements. So that means it's March now. I take from March last year to March of this year, and we take all the deposits that go into it. Now, some people, I take the average to at least see if you qualify. We add all the deposits up. We divided it by 50% of your expenses that are going to be taken out for taxes. Now, going into that, we can do less expenses taken out, so we can give you some more income, but that comes with a new CPA letter stating that, hey, you work from home from this, you don't get that much expenses out, all that. But that's kind of nitty gritty, but that also comes with, let's see where you're at first. It's more a personalized one.
50% means you don't have to have that letter. Anything below 50% debt ratio, it means that you have to have that CPA letter. And I just had one where we have a company that we can call that will actually do those letters for you at the lower amount. I just had one done. It's a little pricey, but if that's the only way you can get the loan, a little bit of extra money goes a long way.
Yep. And those are I think those are the best for, like the LLC owners, hey, you're a 1099. And this is also, we're sticking with investment properties, but it also is for conventional loans if you're just trying to get a primary too. So that kind of helps a lot. But it's great because I know a lot of people that do real estate investing or are self-employed owner, they don't show anything on their tax returns, and it's very hard to be like, oh, what can we do? These are great. If you want to show some income and you're not ready for the DSCR, you're like, I'm not going to fully rent that out. I may do a little bit. I may make this my second home, but then I rent it out when I'm not here the 50% of the time. This would be perfect. Correct. That way you can show that income on there as well.
Absolutely, absolutely.
And I like numbers, so I like to calculate everything.
Calculate all the numbers. So when you're thinking about buying and investing in property, you want to do a little bit of due diligence on your own. Things like you want to check. There are some places that will not allow you to rent your property as an Airbnb or a Vrbo or anything. They require that you have at least 1 month. It could be a month-to-month rental, but it cannot be a daily or anything like that. Sometimes we run into that. A lot of that is with condos and things, and you'll run into that.
With the HOAs.
So you want to check and make sure that the properties you're looking for allow you to do what you want to do to get the rental income. Again, you want to remember that 1-to-1 rule. You want to make sure that, don't go out and buy that $900,000 house and think that it's going to be something you can rent and you're going to get full rental to cover your mortgage, because you might not. This is, I don't know many people that usually do those bigger properties. Some people do now and again, but generally you're looking at a property that's going to be somewhere, your mortgage somewhere in the $2,000 to $2,500 range, which is an average rental on a 3-bedroom, 2-bath type of a house, something like that. So you want to make sure that what you're buying is really going to bring you the money in.
Exactly.
There are some people that buy properties because they want to lose money. Or show that they lose money on their tax returns. But again, you want to make sure that you're going to be getting your 1-to-1 ratio on that. You want to look at locations. If you're going to tell us that, okay, I'm going to use it as an Airbnb and all of that, well, look at where it's located. If you're in not Babcock Ranch, but out in
Alva.
Alva, there you go. Yeah. Or out in, you've got this great deal on a property that's an acre or whatever. I don't know that you're going to be able to do an Airbnb. How many people are going to want to rent that? You may need it as an annual. And if it's an annual, you may not make as much money on it as you would have made if it were an Airbnb. So definitely do your due diligence to find the right properties. It's not any property does not make it that way. You want to make sure too about the as far as the house in decent condition. Unfortunately, if it's not in good condition and you want to buy this house, fix it all up, and then rent it, well, you can do that, but we cannot do a rehab loan, we can't do a lot loan, we can't do a construction loan in conjunction with a DSCR loan or a bank statement loan. It has to be a full doc loan, which again, we can do, and we can do it as an investor. And we do have specific rehab investor loans where basically they want you to turn and burn. They want you to do the loan, have it done in 8 to 12 months, then we're flipping it over to an investment property, all done. And they give you special, special things as far as what needs to be done on the house, how much much they're going to loan, what they're going to do. So we do have specific rehab loans for investors, but they are full doc. So you always got to keep in your mind, if you're doing something with less documentation or none of your documentation, then it's going to be something that is a straight investor loan, no rehab, no lot loans, no construction. And I think that's about for me as far as taxes. I mean, you want to make sure you're not looking at just your principal and interest. You're looking at the taxes, insurance, all of that goes with it.
Yeah, because if you want to make sure everything covers
HOAs,
you want to make sure everything covers so that it's not always an expense. It's an investment. You're actually going to make money from this real estate, which is kind of it's hard, but that's why I always say, like, if it needs work, that's probably not the best investment property that you want to do.
Not really. It might be something you might want to buy and sell right away.
Oh, absolutely.
Which would be, again, a turn and burn is what we call them, you know, get them in, get them out kind of thing. And we do have loans for those, but again, full doc.
Right.
You just got to make sure that you're showing that. And that's something you can talk to your CPA about, or your attorney, and let them know what you're planning on doing, so that maybe we don't write off everything, or we write off just what you need or whatever, so that you do show the income on that. And there are items that we can add back in to give you income, but again, it's just a matter of setting yourself up with the right expectations at the right time.
Correct. And then choosing the right loan type is what we're trying to figure out. So like an investment home or a second home. We have a lot of, being in Florida, we have a lot of snowbirds that come down here. But we do have a lot of snowbirds that come down here and they rent out the rest of their homes the rest of the time that they're not here, because they're like, why am I just letting it sit there? Nobody's going to touch it. Nobody's going to do that. So the difference between like an investment home and a second home / vacation home that we do, a lot of the investments do from 15% down to about 25% down. Now going lower from 20, you're definitely going to get a little bit of a higher rate depending on your credit. Again, that's also a thing, but they're used more for like a full-time rental or an Airbnb.
And keep in mind, anything 10% down or less, or 20% down, less than 20%, excuse me, you're going to have PMI on that also, even an investor in a second home.
Correct.
So, you know, with a DSCR, you're not. No. With a bank statement loan, you're not, but you will with a conventional loan.
Yes.
So that 1-to-1 ratio, again, may not fit. So we want to make sure that if you're buying it as an investment, or, you know, that, again, that it works for you that way.
Now, say you are going to have that second home and then you're going to rent it out later on. You can go down to you can do the little as 10% down, because it is your home. It's going to be your home. You are going to occupy it some sort of the time, but we also can put the rent in there to help you
to offset
your DTI at that point, with your debt to income ratio, which tends to happen because we say, like, hey, if we talking to you and we're like, hey, I'm looking for a second home, are you going to be renting it out at all? I don't think so. Your DTI is just over. How about we rent it out a little bit? You're not going to be there all the time.
Right.
But we can rent it out just a little bit, and that's perfect.
Yep. And you don't have to have an actual lease already set up on that. We can do a comparative rent schedule from the appraisers who go out and actually take a look at what's in the market and what can be done. So, or you know, what income it's going to bring in.
And intent always matters. Always matters to us, because we need to know if you are going to make any money from this, because that's always going to help. And then also, if you're not going to rent it out, how are we going to qualify you? And that portion of it, it's almost like, okay, well, what are we going to do with it then?
And here's the other thing. The way Fannie Mae and Freddie Mac, who make our guidelines, and that's a conventional loan, they really don't look at second homes as second homes any longer as far as pricing. I mean, people used to think, okay, call it a second home because your pricing is going to be so much better, but it's not anymore. Fannie Mae, Freddie Mac, they caught on to this idea. So you might as well do it as a DSCR with less, you know, our job is to make your life easier. And if not asking for tax returns, bank statements, all of this stuff makes your life easier, then why not?
Well, because when they say the second homes, they say I live in Cape Coral. I want to get a little place closer to the beach in Fort Myers. Well, you're less than 50 miles away. That can't be your second home. But I want to call it as my second home. I can't because I live less than 50 miles and I'm already at the beach. What do you mean I can't have a second home? But I want to stay there so I don't have to drink and drive all the way back home.
Right.
I just want to stay there. Doesn't matter. But if I list it as an investment property, I can rent it out.
You can do whatever you want.
I can do whatever the heck I want with it. So that always works with that. But knowing to classify how to do it, let us figure that out. And again, we'll talk to you. If you don't want to rent it out, that's perfectly fine. If you live in another state and you are a true snowbird, we love you. This is how much we make money from you coming down here and coming to visit us for some of the year, even though driving is a little hard sometimes. Thank you.
Oh, that was you this morning.
Oh, yes,
anyway,
it was.
I went across the Midpoint Bridge. Don't know why.
I was already in line and it was already there.
A minute quicker to go on the Midpoint, so I took it. And then you said that you were behind, and I'm like, oh, I'm so glad I missed that other bridge.
Oh, yeah.
Yes. So anyway, but we love it down here.
Yeah.
So when you're talking about building your portfolio, and when we talk about that, your portfolio is your investments, your land, your lots, your houses, any of that. So you want to start with at least one property that has a cash flow.
Absolutely.
So take your money, buy a property, and then start getting income on it. So in other words, when I'm saying don't buy that house that needs rehab work, because now your money's sitting stagnant. Buy the house that is either, maybe it's empty right now, or better yet, maybe it already has a renter in it. And it's an investor selling a piece of property that already has a renter in it. So
they can stay in there. They can stay in there, and they can take over, the new owners can take over the lease and let them stay in there.
Finish it up that way.
They don't have to move.
So you're already setting yourself up with money ready to go. So that money is now going into this account, and you don't need it for anything, and all you're doing is you're building another little nest egg here to go ahead and buy another one. Let your equity start building too. Kind of the same idea. If you buy something and you've got some money down on it, and then maybe you start putting some more money against it or whatever, the more it appreciates in value, then use that equity to turn around and buy something else. And we can do that. And then we also have, we didn't even talk about this one, we have loans that are called blanket loans, where you don't even have to take a home equity loan off of one property. You can actually take that property and put it together with the property you're buying and use the equity that way. So lots of ways to get your equity to help you build that portfolio that you're looking to do.
A little bit harder, but we don't usually tend to go that way, but it's an option.
Yes. But and here's the other thing you want to, before you start doing all of this, decide if you're going to have a property manager. Decide if you're going to do the work yourself. It's a lot of people think, okay, I'll be the landlord. It's super easy. But when you're getting the phone calls at 1 o'clock in the morning, and you have to go out and fix a refrigerator, or the water doesn't work, or the air conditioner doesn't work, and all of that, you need to make sure that you have a guy. I always have a guy for everything. I've got a whole list of guys that do all these different things, and I know they're good, and I trust them with what they do. So put together a team. Find a realtor that you love, that you work really well with, and then just say, keep an eye out on properties. If you ever see something in this amount, or in this price range, or in this neighborhood that looks like a good deal, reach out to me. Because you've got them doing the work that you would normally be doing. So this is a little business. So you want to be able to delegate, you want to be able to do all of that. If you're going to have more than 1 or 2 properties, you might want to look into a property management company. or hire a property manager or whatever the case may be. Yes, it does take away from some of your income. And I do have people sometimes who say, oh, well, I've got to pay them. But again, it kind of goes back to if you've got 3, 4 properties,
that's hard.
That's a full-time job.
Yeah.
And if you have a full-time job or you're doing something else.
Especially if you're starting off.
Exactly. It's very hard to run all of that and follow up. And if you have a property manager, they're collecting the rents.
Absolutely.
If they don't pay the rent, the property manager is calling them. Property manager is saying, hey, here you go. They're reporting it. They're doing whatever. They're keeping you appraised and also asking, how do you want to proceed?
Absolutely.
But you're not worrying about that. You're just watching the money get put in your account and moving on. And they're the ones that are handling that. And if the sliding glass door breaks, or if somebody calls and says, hey, they've got a dog in this house and it's not supposed to be, they handle it. You don't have to. That's what you're paying them for. So you want to definitely build your team. And then the other thing is every year, kind of like you do with your mortgage, we tell you to do an annual mortgage review. Take a look at your mortgage, look at your homeowner's insurance, look at what hit you on taxes and all that. You want to do the same thing with your rental properties. Every year, review your insurance. Take a look at what taxes did. Did they go up a lot? Did they not go up? Why? What do I need? Because maybe it might change who you elect, or maybe what you want to have happen in your community, how you want to vote for certain things like that. You also want to take a look at, did this property, did the so-and-so pay rent on time all the time? Or did we lose money because we missed rent?
Do we need to raise the rent? Do we need to do this? Do we need, what do we need to do? What do we need to do to make more money? Should we invest? If we're Airbnb-ing it and we're not making as much money as we thought we were going to be making, we're taking a loss at it. Should we change it to a long-term investment?
Exactly.
And that's something you don't even need to notify us about. You just need, if you decide if you want to do it.
Correct. Yeah, so definitely do the 12 months. Again, just an annual review of your life and your business. So,
and we always like to say a good way to start. Say you're starting out. I want to buy an investment property. I want to do like a down payment. I own my own house. I've got a decent amount of equity into it. What can I do with it? You can refi it and do a cash out refi. You can do it that way, so you don't have a home equity line on your home. Say you already have one that you're like, nope, that's for my home. I like to keep it to just my home. We could just refi. We can refi your house, do it that way, and then get you some more money. I personally like the home equity line. That's my personal way that you should start out, because those are just interest only payments. So that way, whatever you're making on that property, pay it off. And then it's still whatever it's still there for whatever you need to do. Because that way, when you start cash flowing your new home and you pay off that home equity line, you have that open up. So if you want to just go buy another one and use the down payment for that, there you go. And then that just starts cash flowing you start paying everything off, and you're just
exactly.
Bing, bam, boom.
And that's a good thing. We have a lot of investors who start that way. They start with, $200,000 in a home equity line or something, and they go and put $50,000 down on this property, and then they still have some money, or then they put a little bit more, and and again, you've got your team, you've got your money, you've got your backing, you know what you're going to do, and then you decide, okay, I'm good now. Let's put a halt on it now, or let's keep going, and that's how a lot of people make money. That's how they get, like you said, cash flow going and all of that, and it could get to a point where you have such a good cash flow coming in.
You can just start buying you can buy it cash.
Buy them
you don't
cash,
even need to
and
do
that's
anything.
even a bigger cash flow. And then maybe you retire or quit working your full-time
and then
job.
They're your property
property
manager.
You could do that, or keep your property manager and you go on vacations all the time. However you work it, there are many ways to help you with your cash flow to purchase homes. So
I do recommend, when you are starting out, don't buy 3 different houses.
Too many.
Don't buy too many houses at once. You want to get your feet wet, get your bearings done, see how it works out. also, and that helps you go, okay, how much money am I making in this area? How much money can I be making over here? Could I go over here and make a little bit more money? Or should I kind of spread it out and have like should I have a long-term investment over here and then Airbnb over on this side of it and everything? And then once you are able to do that cash flow into your properties, and then you can start actually banking money with and you're paying for these houses that you can just pay cash for. You also can do what's called delayed financing. Say, hey, I just bought this house less than a year ago. I'm ready to take some money for cash. I'm ready to take some more money out of it to go buy another property. That's another way that you can actually do it, and it's great. But I also recommend start with one, get your feet bearings. That way you're kind of learning how to cash flow. You're starting, and then that way you're not trying to buy everything at once. You're not seeing it happen all of a sudden. You're like, wait a second, what happened? And I'm supposed to do this, and it's like, hold on a second.
And one of the other things is the last thing you want to do is to have bought 3 or 4 houses, and then God forbid, either one person doesn't pay their rent or something, or then maybe the refrigerator goes out in 3 of them, and you're having to spend $1,000 on, $3,000 right out of your pocket.
Because I think of it as like you now own 3 homes that you have to pay for, not the renter. The renters don't have to pay for it. That all comes out of your pocket. So it's more of like, okay, let's start with one, and then, okay, we've got this ready, start another one.
And then we got this one. Right. And and you decide which properties, do I want a single family, do I want a condo, do I want a duplex?
Duplexes are good.
And exactly. I mean, a duplex costs the same as a single family residence, only you have 2 rents in one and 1 rent in the other. So, again, many, many different ways. We can always answer questions about the financing and how to put something together. We're always here to help you put the puzzle together and to answer any questions for you. So if you do have questions, either give Mallory or myself a call. Got our information up on the
Not today. Not today.
Okay, 239-789-7561. Your lender for life. So, we can definitely give us a call, and we can put that together for you. So, give us a call. Great talking or seeing everybody again today. And look for us next month. Don't know what we're going to talk about in April, but
I don't know yet.
We'll find something good. And if you have any ideas, put them down in the comments, or give us a call and let us know what you're thinking or what you'd like information on. So
I agree.
We'll talk to you soon. Bye.
Bye.